Good day to all of you. It's really a great pleasure to make a few introductory remarks and to welcome you on behalf of ICMA to this important event. And firstly, thank you very much to our partner today, Ashurst, for their support and for the opportunity to examine this critical sustainability-focused topic. In this last rather extraordinary year, the importance of moving more rapidly on decarbonization to meet the goals of the Paris Agreement has become front and center of the global policy agenda. We rightly expect our governments to act decisively on the existential threat of climate change, and indeed an increasing number of governments are doing so. But the role of private finance is also critical, and capital markets are stepping up to the challenge to provide the levels of funding needed to develop new technologies and to change processes. At ICMA, with the full support of our diverse global membership, we've been privileged to take a leadership role in the development of the sustainable and climate finance market, starting with the green bond principles back in 2015. We're now seeing rapidly accelerating interest from both issuers and investors in this market, with record levels of issuance of green bonds in 2020, and even faster pace of issuance this year. The green bond principles have become the de facto global standard for green bond issuance, and some 95% of sustainable use of proceeds bond issuance to date follows our green, social, or sustainability bonds principles. Notwithstanding recent concerns regarding greenwashing in the financial products arena, the sustainable bond market remains one where transparency is high and credibility remains intact. And trust in this market is of paramount importance. While green bonds are now a well-established product used by many issuers to finance or refinance specific green projects or assets, our publication of the sustainability-linked bond principles in 2020 gives guidance to issuers taking a more holistic view of their sustainability strategy in all areas of their business, including the transition to net zero carbon. These new principles allow companies to set measurable sustainability performance targets using key performance indicators against which they're assessed, with the understanding that failure to meet them will result in a meaningful financial penalty, for example, requiring them to pay a higher rate of interest to investors. This is already proving a popular route to transition with companies in a wide range of industry sectors, and an equally popular product for investors in the ESG space. It's also a very inclusive approach, which we hope will encourage companies in the so-called hard-to-abate sectors, fossil fuel companies and the like, to finance their climate transition strategies through the bond markets. We cannot expect to achieve our climate goals without their involvement. And we also believe that the two approaches, the green bond use of proceeds and sustainability-linked bonds, are highly complementary. Significantly, also in 2020, ICMA published the Climate Transition Finance Handbook. This is designed to support the growth of climate transition finance by giving clear guidelines on the disclosures that should be made by issuers on their climate change strategy when they raise funds in the debt capital markets using green, sustainability, or sustainability-linked bonds in line with the principles. We're hopeful that this new guidance on climate transition will allow a wider range of issuers to participate with credibility and with transparency in the sustainable finance markets, and will contribute to a faster transformation of the climate-friendly global economy that is so urgently needed. Today, we'll look to our panel to clarify some of the fundamental questions related to climate finance, not least how a sustainability strategy at the national or corporate level can be evaluated to ensure that it will adequately contribute to net zero greenhouse gas emissions and the ambitious goals of the Paris Agreement. Before we start the panel, it's my pleasure to introduce Mr. Takashi OMOTE. Mr. OMOTE is Deputy Director General for Environment, Energy and Innovation at the Ministry of Economy, Trade and Industry. Thank you for joining us today.
Thank you. Thank you very much for your kind introduction. I believe that a finance sector is making and will make a vital role for carbon neutrality. Therefore, I'm very excited about this opportunity. In my speech, I will touch on my ideas related to questions that will be asked at the panel discussion. I hope it will be helpful for the panel. Next slide, please. Firstly, I'd like to explain actions Japan is taking now. On October 26th last year, Japan's Prime Minister Suga declared carbon neutrality by 2050. He recognizes that climate change is a pressing challenge for the international community. He also thinks that action for climate is no longer a constraint, but an opportunity for economic growth. Japan tries to realize this virtuous cycle between the economy and the environment concept while achieving carbon neutrality. We have thought the key of carbon neutrality is innovation. In order to clarify ways to actualize carbon neutrality through innovation, we published the Green Growth Strategy in December 2020 last year. We specify action plans for 14 sectors such as hydrogen, offshore wind power, and storage battery. To make our carbon neutral policy credible, we will check and update this strategy continuously. Based on the strategy, Japan founded a 2 trillion yen, around $20 billion Green Innovation Fund. Experts are examining proposals now, and projects will start this summer. We think that the carbon neutrality cannot be achieved only by the government fund. Private sector's money is indispensable. So we founded this fund as a seed money to induce 50 million yen, around $150 billion of global ESG investment. Next slide, please. Secondly, I would like to stress the importance of transition finance. The climate crisis is an urgent global issue. So we tend to focus on actions with clear pathways to carbon neutrality. However, realistically, not all industries and countries will be able to take these actions immediately. Fossil fuels are still essential for manufacturing processes in many cases. Those fuels are still the most affordable energy resource in many countries. Then, manufacturing industries and those countries need a feasible approach. Transition. Transition means, in the sense of climate change, a shift towards decarbonization and low carbonization of industries, where real greenhouse gas emissions cannot be expected in the short term. Typical transition products are highly efficient power generation facilities and energy conservation processing systems. Transition is needed earnestly in real business. Therefore, enhancing transition finance is important for tackling climate crisis. Next slide, please. Thirdly, I will explain current challenges to develop transition finance in ICMA and Japan. some financial institutions found out the potential of transition. Several institutions issued transition bonds. Although there are principles for green bond and other sustainable financial instruments, there was no international consensus about transition finance. Then, ICMA set up Climate Transition Finance Group in June 2019 and published Climate Transition Finance Handbook in December 2020. ICMA was working on drafting the handbook openly. Then, several Japanese entities joined the working group. In parallel, in Japan, a study group on environment innovation finance, organized by our ministry, Ministry of Economy, Trade and Industry, or METI, issued a concept paper on transition finance in March 2020. In the process of drafting the handbook, many Japanese firms also sent comments to the draft of ICMA's handbook. As such, Japan contributed to the handbook. I am delighted that ICMA's working group evaluated the work of the issuing the concept paper by Japan's study group and the handbook. The handbook mentioned this activity. METI, together with Japan's Financial Service Agency and the Ministry of Environment, set up a task force in December 2020 to develop Japan's basic guidelines on climate transition finance in line with ICMA's transition handbook. The draft was made by the task force and will be finalized in a few weeks. In addition, METI is going to develop roadmaps of industrial sectors, in particular, high greenhouse gas emitting industries, aiming to support them in referring to the roadmaps when they are engaged in financing of transition activities following the guidelines or ICMA's handbook. In order to ensure credibility, third-party assessment is recommended in the handbook and also in the basic guidelines. METI will support those companies for their third-party assessment costs. Together with it, METI also establishes a scheme of an interest subsidy for loans. Industries and financial sectors in Japan seem to be ready for transition finance now. I'm looking forward to the participation of global players in it. Next slide, please. Finally, I want to touch on our plan to realize Asia-wide transition finance. I think the basic guidelines and the roadmaps we are drafting will be also effective in other countries. Because the climate crisis is a global issue, the government of Japan would like to cooperate with others. Enhancing transition finance by using these documents will be one of effective cooperations. At the area of promoting transition finance, I think that ASEAN countries are especially important because the price of renewable energy is not so competitive and there are expanding demand for energy. Achieving carbon neutrality is a very keen issue. So we would like to make an active contribution to the transition toward decarbonization from ASEAN to the world. Thank you very much.
Mr. Omote, thank you very much for your presentation. We will now hear from Dr. Zhen Ma, Chairman, Green Finance Committee of the China Society of Finance and Banking.
Good morning, good afternoon, everyone. First of all, I'd like to thank ICMA for inviting me to join this event on net zero carbon and Asia Pacific capital market. I've been working with ICMA for quite a few years, as early as in 2015, when I was leading the drafting of China's green bond catalog. We studied very carefully the green bond principles, which was hosted by ICMA. And during the period of 2016 to 2018, when I was a co-chair of G20 Green Finance Study Group, we also consulted quite extensively experts organized by ICMA. I think a knowledge platform such as today's event is very important in forming consensus and build capacity on issues like sustainable finance. Given that today's topic is net zero, I'd like to spend some time on how China is developing strategy in implementing the carbon neutrality goal, which was announced by Chinese President Xi Jinping in September last year. At the sector level and regional level, there are lots of efforts given to developing roadmaps. For example, I personally was organizing a team to study carbon neutrality roadmap for Chongqing municipality, and we spent almost a year already. And it's a carbon neutrality roadmap for major industries such as energy, transportation, building industry, and the forestry sector, coupled with strategy or plans to finance them. Just for Chongqing itself, we found in the study that in the coming 30 years, Chongqing will need to spend roughly 13 trillion RMB to deliver its carbon neutrality objective. And many sectors are now doing their roadmaps, especially in the energy, building, and transportation sector. So I think within next 6 months or 12 months, many of these roadmaps will be formalized, and concrete actions will be taken by regions, sectors, and major companies. Now, let me just switch to the finance aspect of the carbon neutrality and discuss a little bit on opportunities, risks, and also the actions to be taken by the financial regulator and the financial industry. In terms of opportunity, our estimate at the national level shows that in the coming 30 years, there will be at least 100 trillion RMB required for green and low carbon investment. And some experts are looking at something like 400 trillion RMB. So it's really anything between 100 to 400 trillion. It's a range of estimates for investment opportunities. And the financial industry will definitely find it's extremely exciting in order to tap into these sectors' growth. And on the risk side, certainly with the carbon neutrality goal, the transition risk will become much more evident. Just in the past few months, there's so many discussions on coal-related transition risk, and also experts are beginning to look into financial risks arising from exposure to other high carbon assets, such as those in the industries of steel, cement, aluminum, and so on and so forth. Our own study, which I led at Tsinghua University, shows that the NPL ratio for loans for coal-fired power generation sector is going to go up from the current 3% to more than 20% within 10 years because of the reduction in demand for coal and coal-related energy, such as coal-fired power generation, and the rapid decline in the renewable energy price, especially solar and wind, as well as the increase in carbon prices. So these are the pressures which will significantly worsen the financial performance of the coal-related companies, and therefore raising their probability of default. So this message is now getting into the minds of top managers of the financial industries, and many financial firms, including the big banks, have set up their teams to begin to conduct analysis on environmental and climate risk analysis. Now, moving on to the policy framework, as you know that China has developed a policy framework for green finance in the past few years, including 3 sets of taxonomies, some disclosure requirements, some incentives, and a range of products, including green lending, green bonds, green funds, and so on and so forth. But these are not considered as enough in light of the carbon neutrality goal. Therefore, the authorities are looking into further revisions of taxonomy, disclosure requirements, and incentive structures. For example, on the taxonomy side, the newly developed Green Bond Catalog has removed the clean coal technology as a green finance item. And in the future, I think more fossil fuel intensive projects will be removed from other taxonomies in the green finance space. And in terms of disclosure, previously we were focusing more on pollution-related information. And going forward, the Chinese authorities, especially the banking and other financial regulators, will begin to require disclosure related to climate, especially carbon information. My view, which is presented to the regulator, is that the banks will need to be required to calculate carbon footprint of their loans and to disclose such information. And in terms of incentives, we need to strengthen on top of the existing incentives, such as re-lending facility, green subsidies, as well as green guarantees. Specifically, I'm looking for a much larger re-lending facility to support green and low carbon projects on an annual basis. And I think the authorities should and will look into the options of reducing risk weights for green assets and increasing risk weights for brown assets. As for products, there are many innovations that's popping up. For example, we've been seeing zero carbon bonds or carbon neutrality bonds recently in China. And there are institutions now exploring the possibility of developing carbon footprint related or linked green bonds and green loans. And there are transition finance products popping up, for example, transition bond. And in the future, I think there will be transition funds launched to help companies in the high carbon sector to transform themselves into low carbon companies. And in the carbon market, there is extensive discussion on how to go beyond the spot market, which has been planned, and it will likely to be the largest carbon spot market in the world in the coming few years. But we need to have carbon derivatives, including carbon futures. That's something likely to be launched in Guangzhou in the Guangzhou Futures Exchange. And in terms of the carbon neutrality of the financial institutions themselves, a couple of companies, including Haitong International, has announced that they are going to achieve carbon neutrality for their own operation by 2025. And Ant Financial and Tencent have also announced similar objectives. I think it's becoming a trend within the Chinese financial institutions that they will begin to seek their own operation, including building and travel, to become carbon neutral. Now, finally, just a few words on the international side of the green finance. China has been quite active in developing international collaborative initiatives. In the past few years, one of the most important schemes is the G20 Green Finance Study Group, which was later renamed to Sustainable Finance Study Group. I had the pleasure to co-chair the group between 2016 and 2018. And this year, the Italy presidency of G20 proposed to relaunch the study group, and it was successfully approved by the central bank governors and finance ministers. And this group will be looking into issues related to sustainability reporting standards, taxonomy, and also role of IFIs in advancing sustainable finance. The other major platform on sustainable finance is NGFS. It's called the Central Banks and Supervisors Network for Greening the Financial System, where China was also playing a major role as a founding member. Last year, I led the report on environmental risk analysis methodology, which is now, I think, being read widely by the financial community, which is looking for tools and models to quantify the environmental climate risks arising from their exposure, for example, to high carbon assets. And just to mention the IPSF, International Platform for Sustainable Finance, which was launched by EU, China, and a dozen other countries back 2 years ago. And this IPFS has set up a working group on harmonizing taxonomy. This working group, which is again co-chaired by myself, will be developing a common ground taxonomy based on the Chinese and the European taxonomy. And I think the common ground taxonomy will be used on a voluntary basis, not only by Chinese and European investors or issuers, but can be used on a voluntary basis by other markets. So let me stop here for my remarks, and like to thank ICMA once again for inviting me to join this event, and I wish the conference a great success. Thank you very much.
Thank you very much, Dr. Ma. My name is Mushtaq Kapasi. I'm Chief Representative for Asia Pacific for the International Capital Market Association. I want to thank first Mr. OMOTE and Dr. Ma for the very detailed and candid overview of climate transition at the national levels in China and Japan. Now, we'll turn to the panel discussion. We have about 50 minutes left, and we'll look more closely at the concept of net zero and what it will mean for the regional financial markets. I'm delighted to introduce today a very experienced and also very diverse panel. We have Siyuan Fang from McKinsey, Darsha Mirando from China Water Risk, Anna Marie Slot from Ashurst, and Bernadette Victorio from Fair Finance Asia and Oxfam. Okay, welcome to all of our panelists. Please come online. Okay, I'm going to start with a definition, and we'll go from there. So net zero. The UN Intergovernmental Panel on Climate Change defines net zero as being achieved by cutting emissions to as close to zero as possible over a specified period and compensating for any remaining emissions with projects that remove emissions from the atmosphere. Now, if I read this as a lawyer, 3 questions immediately pop to mind. What does as close to zero mean? What does specified period mean? And how do you know which projects remove emissions from the atmosphere and how to measure them? So let's start with Anna Marie. Anna Marie, you've looked at this question very closely. You've seen a number of definitions of net zero in the market. How do you define net zero? And how do you evaluate some of the various ways of looking at that have come out in the public sphere?
Thanks, Mushtaq. Yeah, so go to the lawyer with the tough question first. That's fine.
That's my strategy.
No, that's fine. Look, you hit the nail on the head, really, in terms of what the challenge is around net zero. There, we've heard from the speakers today about where they're going and how they're trying to get there. But the question is, is what do they mean by what they say, right? And that's a real challenge in this area for all of the reasons you point out, right? There is net zero, which is technically defined by various different groups of people as achievements of certain objectives over specified times. There's carbon neutrality, there's climate neutrality, there's net zero GHG, there's net zero carbon. There's lots and lots of iterations of what people mean when they say these words. It's a great phrase. And in fact, I fully support everyone getting on board with making commitments of these types, right? Because, the big picture is we do have to extract what we've done so far, and we have to get to a place where we can have a sustainable and resilient world going forward. So the goal is definitely, I think everybody is there with it. I think the point of this panel today, and I'm very interested also to speak with everyone else on the panel, is to figure out what people mean when they say those things. So a lot of the net zero claims are questions that you just have to look into and ask, what do you mean by that? Because net zero is a fantastic tag phrase, right? It's very short. You can put a hashtag in front of it. It goes viral well on social media. But when people say that they are committing to net zero, are they committing to a Paris-aligned goal by a certain point in time in their operations? To do that, you will have to actually look at everything. You know, the presentation from Japan was fantastic because it shows you all of the different iterations of what they're doing to get to the result. It's not a very exciting part of the analysis, much more exciting to talk about net zero, but you actually have to sit down and figure out exactly where your emissions are, where you are, which emissions you're tracking. Are you tracking CO2? Are you tracking methane? Are you tracking nitrous oxide? What of the GHG ones are you tracking? And to be clear, if you want to be Paris aligned, you have to be tracking all of those, right? And then what does that look like on a net basis, which is the really fascinating bit here, right? Because we are living on the same planet, and so it is a net outcome, right? If one person is going crazy putting stuff in and one person is going crazy taking stuff out, it depends on how those two are balancing. And so I think that's another really, really interesting bit of what we can talk about here today. But I don't think I added any more light to this to the question. I think just took the lid off on how complex that really is, and how when you hear that, it's just kind of, it should be a moment where you think, okay, they've said this to me, but what do they mean by this? And how are they planning to deliver this?
Absolutely. Well, thank you very much for that. And I think that's part of the point of this conversation, is just giving those in the audience the tools to be able to look at these net zero pledges and strategies a bit more critically. Let me hand it over to Darisha, who I know has been doing this for some time already on a professional level. And Darisha, you've thought very carefully about how, as Anna Marie mentioned, how to aggregate these together, right? It's not just about looking at individual net zero pledges, but looking at how they all kind of come together, and also looking at the net effect of the actors towards climate transition and the non-actors. So could you give us a sense of, globally, when you look at the net zero pledges, is it sufficient? How much, how far do we have to go? What else is needed in terms of the net zero strategies that we have globally?
Thanks, Mushtaq. So at CWR, we very much look at climate change from the impacts angle. So that's why it's really important for us to understand overall where we're heading. What does it mean for everybody in terms of climate change, with all the pledges, all the policies, et cetera, coming through in terms of impacts. But I think it's important to know where we are today. So the Paris Agreement, the target is to make sure that we hit 1.5 to 2 degrees, or we stay below that by 2100, compared to the pre-industrial period. But today we've already got to 1.1 to 1.2 degrees. So we're quite close to our target already. And if we keep going the way we're going, we could be looking at 1.5 degrees by 2030. So that's 70 years ahead of our Paris Agreement target that we could be reaching. So the pledges are very, very important, because without them, we could be heading to at least 4 degrees, which is a lot. But with the pledges and the policies that have come through from China, Japan, South Korea, US, etc., we're still only going to get to about 2.5 degrees. And even there's a range. So it's about 2.1 to 3.3. So that's quite a range. And obviously some will do more than others. And obviously a pledge does not translate into doing unless it's all in the policies and actions are being taken. But even at 1.5 degrees, we will already see multiple physical impacts. And we've seen a lot of this already, which we can talk about later.
Okay, thank you very much, Darisha. Now, for Bernadette, in your work at Fair Finance Asia, you looked very carefully at bank balance sheets, at the way they invest, at their exposure to carbon as well. So could you tell us a little bit about how you evaluate the potential transition pathways or the potential strategies, particularly in the finance sector, but certainly more broadly, and in a way that is informed by your experience in looking at their current exposure, what they're able to achieve, and what they're disclosing currently?
Thank you, Mushtaq. And yeah, definitely in the Fair Finance Network, we are very closely watching and reviewing what these net zero commitments are, because they're becoming very trendy. And as Anne-Marie said, you can put a hashtag in front of it and get the very good media coverage about it. But really what we are concerned about is what is behind these commitments, and what are the questions that we really should be asking to understand, the potential loopholes that these commitments and targets are having behind all these great publicity that we are getting. And so while these commitments are very encouraging and well-intentioned first steps towards addressing pressing sustainability issues, it's critically important to check their credibility and strength using certain criteria to avoid these loopholes. For example, do we understand whether they have clear, detailed, realistic timelines within those timelines that they set, 2050, 2060? That includes the long-term, medium-term, or short-term greenhouse gas reduction targets. Are these commitments based on scenarios that limit global warming to 1.5 degrees? As Darisha mentioned, there are certain thresholds that we could reach, and there are many scenarios being set, but not all of them are based on the 1.5 scenario. Do they cover all forms of carbon emissions that go down complicated supply chains and throughout complex portfolios for financial institutions? Do these targets cover Scope 3 emissions, which I'm sure we will discuss more later, and it's a bit more complicated because these are covering the contributions of the companies through the use of their end products and financial institutions' activities and investments. Is the focus of these commitments actually carbon emission reductions rather than over-reliance on carbon offsets such as tree planting or offsetting fossil finance by investing in renewable energy? And are there transparent and credible verification and monitoring systems, as well as metrics, to avoid greenwashing and track progress effectively? So essentially, we see that these net zero targets really are a means to forego short-term profits for long-term goals. And to be very realistic about the cost of delivering them is something that we don't necessarily see, because most of these net zero targets are still being publicized as something of a good business case, of something that will earn you more profit in the future. But is that really true? If you're following some of the articles and discussions that are happening now, and many CEOs are commenting about these net zero targets. One of them was by a German real estate company, CSO, and he says that essentially we have to acknowledge that net zero will require activity to be down as much as in lockdown states for every year for the next 30 years if we are to achieve these targets. And if that was really true coming from a person from the inside, then it means that anything more rosy of a picture being painted other than that is probably not giving us the full picture. And so we have to really analyze these commitments against the realities that are happening on the scene.
Okay, thank you, Bernadette. Yeah, some very hard questions there, which I think the financial industry has to answer, and which I think we all have a responsibility to ask, actually, frankly, behind the headlines. I mean, just some of them, just to reiterate, are the targets actually in line with the are the pledges actually going to achieve the goals of the Paris Agreement, even though they're branded as net zero? Are the goals achievable? And you have to look very carefully at the timelines for those. And are all the potential costs being factored in, right? Are we being too rosy about the economic and business benefits of these? Extremely important questions. So, sorry, I just want to give a bit of a detour because I forgot to mention that we do have Q&A open for this event. We do have a specified time at the end where we can take Q&A from the audience, but the Q&A box is open right now. So please, if you have any questions during the course of the discussion or ones that you thought of beforehand, please feel free to ask them, and we'll be happy to address them to the panelists. Now, I'm going to move over to Xiyuan now. Xiyuan is from McKinsey & Company, the consultancy. And McKinsey as a whole has done some fantastic research, in my opinion, on climate risk and the potential economic impact of climate change under various scenarios. And in particular, done some research on the impact in Asia and some of the financial risks, some of the potential financial costs of not achieving carbon neutrality. And Xiyuan, you in particular have been very close to the industry itself, both the investor community as well as other players in the financial community, banks, et cetera, particularly in China, advising them on strategies and advising them on climate change. So could you maybe, let's turn it a little bit more positive now. We've seen the plans, the outlines of the changes from Japan and China at a national level, but tell us about some of the successful initiatives you're seeing, particularly from your client base and from the industry on net zero plans, on transition plans. What are some of the best practices that you've seen?
Thank you, Mr. Ash. I can't say there are so many kind of best practices yet, right? As other panelists has been commenting, I mean, in terms of standards, setting the calculation tools right, making sure we can articulate the net zero target is still a work in progress. So, but to your question around what are some of the things that we see, right, in the industry, in the financial industry, both regionally, but also particularly in China, I want to make probably two comments. One is you mentioned the report, right? So last year, McKinsey Global Institute, our think tank, published a report around climate risk and response, so physical hazards and socioeconomic impacts. So within that, right, there's a specific kind of study around how climate risk would impact the financial sector, right? The highlight of that report finding is that financial markets could bring forward risk recognition in affected regions with consequences for capital allocation and insurance. So in a way, we're thinking about this not just from a single product, right, or a risk management kind of technique perspective. We're really looking at this from a fundamental asset pricing model perspective. So we're all used to using discounted cash flow models to evaluate, right, any securities, right, be it in the public market or in the private market. And the default, the problem with that model, right, is after 10 to 15 years of elaborate modeling, you're going to apply a very, low but consistent growth rate, right, for the cash flow into perpetuity. So that's what we call terminal value, right? So every security has a very big, right, terminal value that's just modeled in that very simplistic way, right? And if we think about climate risk, and because this is a long tail risk, this is a risk that we probably have to think in decades, right, and multi-decades. That type of modeling just will not be sufficient, right? So in a nutshell, what we're saying is, from the financial industry, right, both on the lending side, on the investment side, had to think about climate risk and fully incorporate, right, the impact of climate change into our thinking about assets and about valuation, about the markets, and that's something the industry is yet to do, right, and with a consistent standard. On a more positive note, as you said, we do see a lot of financial institutions, right, in the region are gearing up, right, to think deeply about sustainability, about their strategy, but also more importantly, taking actions, right, to achieve those goals. A few examples, right, you've heard in the news, Temasek, right, the Singaporean sovereign wealth fund, together with BlackRock, the largest asset manager globally, has been launching a $600 million sustainability fund, right, specifically investing technology related to optimizing carbon footprint. And also, you might have noticed in China, right, there are different locations, and particularly in Beijing, is trying to set up a green finance center. So it's calling for a community of global and local financial institutions to work together to create the carbon bank, right, of China for the future. So I think this type of initiatives are taking place on multiple levels with different sectors of the financial industry. And we're also aware, right, even in the private equity side, right, on the private market, there are certain institutions thinking about setting up sustainability-focused funds, right, to invest in those technologies. So I think this is a very vibrant market, and as Mr. Ma commented earlier on, this is really kind of $1 trillion investment opportunity, right, for everyone, right? So I would say this is both a risk factor to be studied, to be factored in to financial institution and decision making, but also more importantly, this is an opportunity for the coming decades, right? And the financial institutions, together with all the other players in this ecosystem, would play a very important role to shape that new future for this industry.
Okay, thank you so much. And I will make sure we have time to speak about some of the investment opportunities, the risks as well, from the investor point of view, because I think that'll be certainly of interest to those on this call. But before we do that, and we also already have some questions, we have some detailed questions to talk about in terms of some of the more controversial aspects of net zero pledges. So a lot of ground to cover. But before we get there, I do want to stay a little bit general. And we are talking about net zero carbon. We're talking about emissions generally is what people mean. But I do want to take a step back and think about whether that in itself is sufficient. So the environment is not just about climate change. It's not just about carbon emissions. Even though we are focused on net zero here, what other kinds of overall environmental risks should we be talking about? And how do they interact with carbon and the transition under the Paris Agreement? Darisha, I think you're quite qualified to speak on this.
Thanks, Mashak. So I'm going to talk about it from a water perspective, because that's kind of what we do at CWR. And I'm going to split it into freshwater and saltwater. So on the freshwater side, if we just look at Asia, we're facing a triple threat. One, there are lots of countries and regions that don't actually have enough water to develop. So for example, China and India. The second part is that we have a lot of people and assets clustered along these river basins that are already water stressed. So for example, the Ganges, a third of India's GDP and about 600 million people live on it, but it's already water stressed. And if you take the entire year's river flow, it wouldn't fill Lake Erie, which is the smallest of the Great Lakes. Right, so that is just 2 parts, and it's already very stressed, and we have a water issue. Yeah. And then the third part of this triple threat is climate change. So even without climate change, we have an issue here, because developing world where we're growing, there's big urbanization rates, etc. So there's going to be a lot more pressure on our water resources. Climate change can either mean you have too little water, or actually you have too much water and you have to deal with the flooding issue. But this isn't just an EM problem, because in the rest of the world, we also have aging infrastructure. So I have a great / slightly gross stat for you. If I said, which country comes to your mind where there are 400,000 incidents of raw sewage being discharged into the river last year, 400,000, which country would come to your mind? It's a well, it's England. Yeah, and that 400,000 incidents totals 3.1 million hours. Okay, so that's quite a lot, and that's in England. So the next time you go punting in Cambridge, just don't fall into the water. But also, that's one part. In the UK, on average, the dams have an age of 106 years. So there's lots of issues in both the developing world as well as developed, and a lot of money will need to go in to invest in all of this to sort out all of these different problems. And then on the salt water side, I said earlier, 1.5 degrees is guaranteed, and we're probably going to get there by 2030. But already we have locked in a lot of sea level rise. So there's already a lot of melt in terms of our polar regions, and we're locking in about 8 meters plus of sea level rise. That's not going to happen anytime soon. It will be long term, but we've locked it in already. Plus, if we keep going the way we are, and we don't get all of our policies in place for net zero, we could be looking at 3 meters of sea level rise by 2100. So that's very, very plausible, unfortunately, at this point in time. So first of all, even without climate change, we clearly have a lot of problems. So net zero is not going to solve everything, but at the same time, we do need to decarbonize because we need to avoid a very dire future. Plus, I think we really have to adapt because we've locked in so many different impacts already.
Thank you. And I think this is a super important point. Certainly, I've been educated on this very recently, that decarbonization is a necessary condition to solve problems like water, but it's not even sufficient, right? You have to address the other underlying problems of it. And I think your research is excellent on this. I'd actually also recommend the McKinsey research as well, which goes into some of the sort of non-climate effects, including water stress of increased carbon in the atmosphere, and some of the sociological impacts as well. So for that, I'd like to actually transition to, sorry to use the word transition, I'd like to go over to Bernadette as well. And Bernadette, a really big question for you just on net zero as well, because I know you think not only just about the financial aspects, about the climate aspects, but the broader aspects, the political aspects, the social aspects of net zero. And perhaps you can comment on that a little bit as well in the context of Asia, not just looking at individual net zero pledges, but the broader social and political implications of those, and how to make sense of all of the aggregate pledges together.
Yeah, thanks. On the one hand, we are really seeing various entities setting all these net zero targets, including national governments like Japan, China, Korea, in Asia. We have companies and financial institutions that operate across borders also doing the same, where there are non to limited common standards or taxonomies like in Asia. And we really see this as a potentially massive challenge in tracing the lines of accountabilities for these net zero targets, as well as a hindrance to potentially finding a credible way to report and track progress, because there are multiple owners of these net zero targets. And on the other hand, we have all these economic interdependencies. Of course, Darisha referred to it with all the assets that are situated around specific river banks, etc. And we fully understand that not one entity or one country can possibly fully achieve its net zero targets on its own because of this. And perhaps this is the watershed moment that we are all waiting to happen in the realization of this climate crisis. This requires far beyond just setting national targets or company level targets or financial institution targets, but rather a more structured, coordinated, regional, global cooperation where potentially bigger economies are playing key roles in taking the others along through significantly changing the ways about how we think about consumption and production patterns, supply chains, by ensuring that transfer of technology is moving at a faster pace, investing in new business models in key sectors, for example, and reimagining how these sectors would look like if we are to hit 2 degrees rise in our temperature. And we are seeing a lot of these, we are thinking about a lot of these potential forward-looking scenarios in Asia, where a lot of our informal workers are working in open air, where there could be, rising sea levels, where they could be under unbearable heat. And we know this very well in Asia with our tourism industry, with our transportation systems. We have to think about how we could ensure that these societies will survive by ensuring that these net zero targets are not just looking after our own countries, but also taking the others along, because we are very interdependent and interconnected, especially in this region. And strong policy coordination is really important for us to do this and achieve these targets.
Yes, thank you. And I think that's especially relevant given the 2 keynotes today, which I think present very quite credible, at least from what I heard, plans at the national level. And I think actually one comment I'd make about those is I think it's heartening to hear from both speakers that these are also plans in progress, right? I mean, they're open to change and to evolve over time. But Bernadette, you've really highlighted the importance of international cooperation, particularly in Asia, because even if you're reforming markets, you're investing in technology, if those are sort of locked into different, a certain country, then that will not solve the overall social problem. Okay, so I'm going to go shift over to some of the audience questions. We already have a few, and I'd like to leave it to any panelists to answer these. So please feel free to jump in. First of all, on Bernadette, you did mention scope 3 emissions, and I suspect that not everyone in the audience knows or is familiar exactly with what scope 1, 2, and 3 are. Rather than me attempt a definition, would one of the panelists like to do so and to comment a bit about scope 3, particularly in Asia, because scope 3, generally speaking, applies to sort of indirect emissions, to supply chain emissions, and so forth. Who would like to address this?
Nobody's claiming the skips. It's
I
clear.
see you. I see you
No one's
smiling.
claiming the skips. So I'm unmuted. So the different scopes, right, are whether you create the emissions, whether your company creates the emissions, or the scope 3, which is one that people are now talking about, is what is in your supply chain. So say say you're a retail manufacturer, your supply chain would include all of the companies that make whatever you're selling. If you're a fashion retailer, your supply chain is all the way through all of the production of your clothing. That's your scope 3. So what the commitment, when you make various commitments, and as we noted, there's no universal definition of net zero. There's also no universal definition around a lot of the other commitments. There's a thing called science-based targets, which is a very kind of, in some ways, very gold standard type of commitment, which say I'm making science-based targets about my emissions and my GHG to get me to a certain outcome. Those require you to take into consideration your scope 3. So not only what you're doing directly, but also kind of what you're producing along the way. Now, it gets more complicated when you talk about governments, because then you get into a really interesting conversation. If you mine coal in Australia and you ship it to India, who gets to count the coal? Is that India's or is that Australia's? And it gets into a really interesting question, obviously, about kind of social fairness and justice, which is part and parcel of climate change, because obviously countries that have not historically created an enormous amount of emissions are at the forefront of feeling the brunt, especially where Darisha mentions around water, seawater rising, certainly. But so scope 3 means you've gone and you've looked through the whole thing. Now the complication is, as a company, not only to understand what you yourself do, which is not an easy thing, and you need people and time to look into that. But if you go to scope 3, it means you have to track everything that everyone who's supplying to you is doing, and you have to add that in. And so that it is probably a more realistic look at your impact as a company, but it is a much harder thing to understand, because you have to understand. So for example, we're a law firm, right? Our biggest emissions are travel and our premises, right? To get to our scope 3, we have to go through all of our premises, all of our heating, all of our emissions at each of our offices, go into all of those levels and figure out, where our data centers are and what what emissions they're producing as a data center, and our cloud storage, right? So that's kind of the big picture. And so that can get really complicated for companies, and especially, the companies don't have a lot of people on the ground just sitting around looking to analyze this stuff, right? And they also don't have, tons of cash sitting around for consultants to come in and help them analyze this stuff. So that's a challenge around scope 3, I think.
Okay, thank you. And how, maybe this is a question for Bea as well, for Bernadette as well, but how, if you're, say, an international bank, or if you are, a consumer goods company in the United States or Europe, are these companies currently, well, first of all, do they have the data? Do they have the ability to measure and report scope 3 emissions currently? And if so, is there actually a kind of a willingness to do so within the net zero pledges that we've seen? I know a very general question, but just want to get a lay of the land.
Sure. Yes, definitely. You pointed out a very key challenge for most of these reporting to even start and even reviewing this, like the disclosure and the transparency issues that are existing among financial institutions, among the companies that they are financing. And this is certainly a challenge that needs to be addressed. But at the same time, I think linking to the point of accountability, this is very important, because if we think about scope 3 emissions, and when we think about, companies thinking about the effect of their end product being used, or the financial institutions, the impact of their investment or lending or the services, financial services that they provide, I think it's important strategically for all these entities creating these targets, making these commitments, net zero targets, to factor those in, because these are actually important lines of accountabilities that make them own the commitments at the end of the day. We talk about these commitments between countries, for example, where within those countries, there are also companies and financial institutions setting targets. Who in the end is the responsible for the targets of that country? And how would we track, the businesses of the financial institutions and the companies that are home, calling that country home, where they have businesses across borders and there is consumptions, production, supply chains happening outside those countries as well. So again, it boils down to the fact that this requires very profound cooperation between countries. This is not a competition in the end. It's really something that we have to think about as a collaboration that needs to happen and be coordinated at the policy level, but also at the practice level between financial institutions and all other companies.
Yeah, you've really emphasized the kind of planetary nature of this discussion. I know it's obvious, because it's a planet, but when you get into the technical details, such as looking at scope 3 emissions and supply chains, it would be very counterproductive to start having spats between countries about who's responsible for what emissions, right? If you look at it from an international point of view and take collective responsibility, it becomes much easier. Now, I'm going to go to another audience question, which I think is something that we get asked a lot at ICMA, and a relatively controversial one in two parts, actually. What about fossil fuels? Can they be part of a credible net zero policy? And if so, how do you balance the need for economic growth and stability, especially in Asia, which is largely reliant on coal, much more so than non-Asia? And secondly, nuclear. Nuclear is low carbon, but obviously has some risks and is important to several economies around the world. So two-part question. Happy for anyone to jump in if they're brave enough. Nope.
I'm going to just
go for it.
Yeah, I'm going to leave the carbon questions to because I'm not a carbon expert. Okay. But I just want to touch on it on a slightly different angle, which is more we will need a lot of new technology to solve a lot of these problems in terms of getting to net zero. And you keep hearing technology will help us get there, but I think we need to think about a couple of things when we look at technology. One is that it'll require a lot of water. So where a lot of this is manufactured, where a lot of it is produced, we need to think about the water part of it and how intensive it is, whether that region is water stressed, water scarce, and then also the pollution side. The other part of it is that a lot of this technology, whether it's EVs or clean tech, etc., will require rare earth elements, critical raw materials, which is very pollutive. Highly, highly polluting, and we've just seen quite recently the Greenland elections could lead to a reduction in no mining of rare earth elements there because of the polluting nature of it. So then there's a finite supply potentially. So what does that mean? And we are relying on this clean tech, new tech, helping us solve a lot of this, but there might be a finite supply of it.
Mm-hmm.
Okay, go ahead, please, Bernadette.
Yeah. Yeah, we also get a lot of these questions whether oil and gas is, a viable solution or alternative to coal, because we think about the transition process, and we've heard from also OMOTE-san about transition finance and the importance of this period where we are accelerating research and development and scaling up of new technologies. And this is something that I think we all recognize, that we are not going to get to net zero targets overnight, and that this will take a long process, and that we all have to be part of this, and that this is needed to be coordinated at a massive global regional level. But we also have to make sure that in parallel, we are moving towards that process with a plan in mind. And that's where we started in the first place, where I was mentioning about how do we even assess these commitments? Do they actually take into account the long-term transition? What happens in the medium term? And what needs to happen now as part of the research and development, and to scale up these needed technologies that Darisha was talking about? If we compare it to the COVID vaccine, 6 months ago, these vaccines didn't even exist. But now, a big percentage of our populations are now being vaccinated. And this is where we see that there is movement where it is considered necessary. There is political will, there is resources to do that. And if we all agree that we are in the middle of a climate crisis, and that we all have to muster the energy and the political will that we need to move towards that transition, I think it is possible. So I think I will keep it to that.
Okay, thank you very much. Now, I did promise I would get to some more pragmatic aspects of the transition, particularly from the investor perspective. And so I'd like to take it back to Xiyuan as well. And let me put my question quite sharply. From an investor perspective, looking at the net zero pledges, the transition pathways that we've seen promised so far and those to come, if you're an investor sitting in Asia today, what kinds of assets are overvalued? Where are the risks being underpriced? And where do you see the opportunities, both in terms of sort of underpriced assets, I would say, but also emerging technologies and emerging sectors?
Thank you, Mustache. If I would had a crystal ball, I can answer your question. But unfortunately, I can't claim to do so. What I want to do is probably take a step back, right? As a financial institution, as an investor, when you think about net zero strategy, sustainability investment, or sustainability strategy in general, right? And especially when it comes to this part of the world, what are some of the dimensions you might want to think about, right? So we have this conversation with a lot of institutions recently. I think overall, right, you're going to have a holistic target and strategy, right? So what's your long-term vision? What's your midterm goals? What short-term kind of tangible targets are you going to achieve, right? And that links back to a lot of discussion we already had in terms of how to define your targets quantitatively, qualitatively, or what period of time. I think you're going to have a holistic strategy and vision, right, to begin with. And within that and under that, right, you're going to probably think about the opportunities in, I would call it 3 horizons, right? The first horizon, what is the opportunity to transform your existing businesses, right, to achieve your net zero goals, right? What are the digitization and process kind of improvement levers, right, you can pull to optimize your own operations? Some of the banks, some of the insurance companies, they also think about, the Equator principles, right? How do you achieve net zero by yourself, right? As an operation, as a company. So that's probably the first thing you want to think about. And then secondly, as I discussed earlier, around asset pricing, around risk management, what are some of the risk modeling you want to do, pricing models you want to twist, and making sure you incorporate, climate risk, right, in every part of your decision making. Last but not least, I would also say, you're going to have a portfolio view, right? So within your overall, investment lending portfolio, how do you think about the exposure and net zero achievability, right, within your portfolio from a holistic point of view, and how do you continue to optimize your portfolio, to achieve that goals? So I think all of that will be kind of horizon one, right? The things that you should think about, you should do it today, right, to achieve some of your targets. The horizon two, and that's related to your question just now, I think is really around innovation, all right, and building new businesses, identifying new investment opportunities and business models, and drive new business growth, right? And in this area, I would say, there are at least three opportunities, right? One is thinking about new financial products. I think our speakers already talked about some of this, green bonds, or the fund products as well. We also see ETFs, private funds, insurance products, right? All sorts of, carbon, neutral or net zero type of products are coming on into the market. I think this is a very good development, but it's also early development, right? There are so many things that the financial industry can do in terms of creating new products that can tailor to specific investment goals and net zero targets for the investors, right? So I think that's the first innovation. The second one is really around new technologies, right? As the Risha also already mentioned, right? There's so many technology advancements that's required to enable this transformation at a bigger scales as financial institutions. How do you participate, right, in many of these investment opportunities? And a lot of this is in the energy space, right, in the material space, but also you will see adjacent, areas like infrastructure, 5G development, right, and a lot of the adjacent sectors and industries would all benefit, right, from this transformation. I would say there are investment opportunities everywhere. You just don't kind of have a discerning eyes, a pair of discerning eyes to go about it. Last but not least, right, I also argue there should be a horizon 3 in your sustainability strategy, and that's really about collaboration, right? And how do you really build and participate and contribute to a broader ecosystem, right? Because financial institutions are not living in a vacuum, right? So how do you use your power, right, as the shareholder, as the creditor, to influence, right, the companies to move in the direction, right, of sustainability? How do you, be active, right, in the PPP, right, public-private partnerships, to drive some of the initiatives on behalf or in partnership with the government authorities? And how do you think about like co-financing, right, some of the new initiatives, new technologies, and set up, for example, sector-specific, right, funds and investment vehicles to achieve that? So I think, as a financial institution, be an insurance company, a private equity, or investment company, or a bank, there are so many things you can think about in terms of your net zero strategy. But coming back to my first point, I think you're gonna have a overarching and holistic strategy going about it, so that you don't go kind of piecemeal and really miss the big pie at the end.
Understand, and thank you for that.
Can I just,
please?
Can I add a point on the overvalued assets?
Absolutely.
I just want to jump in here. So Bernadette mentioned multiple times that we need lots of governments, companies, etc., to act together, and that's how we're going to get to net zero. Unfortunately, COVID has showed us that we're not very good at that overall. Even vaccines, we came up with a vaccine, but we're not good at sharing it. So this is a bit of a problem. So just looking at sea level rise, does that mean that we're not going to hit our net zero targets? Plausibly, we're looking at 3 meters of sea level rise by 2100. And that means all real estate that's coastal could be overvalued potentially. Is that something that we are thinking about, or is that not really? Because our insurers is really going to be protecting these pretty vulnerable assets in the long term when they don't really need to, because their premiums are renewed annually. But then going back to Sion's point of looking at things from a portfolio perspective, will that push banks, tycoons, to say, actually, our real estate is much more valuable than our coal assets? So we should get rid of our coal assets and protect our real estate assets. So decarbonize that way, and also adapt and protect our assets. So thinking about it from a more portfolio perspective, like you said, could help push this conversation a little bit more as well, and making sure you protect assets that currently look overvalued.
And if I could just jump in also, sorry, Mushtaq, I mean, I think, you know, a lot of the conversation has been kind of about risk and negative stuff, but this is an unbelievable opportunity, right, for companies and for finance for finance in general. I mean, this is the opportunity to create a company that is resilient and sustainable and does things in a way that will be, you know, company A leading the charge on something. I mean, if you are running the company that sat down and did this and knows where it's going and know how it's going to get there, you are going to be on the top of everybody's list for investors. Investors are going to want to invest in you. You're going to be on the top of everybody's list in supply chains, because they're going to realize that they can use you in their supply chains and benefit from it. I mean, and companies know how to do this, right? When asbestos was banned, people figured out how to make brake pads better and cheaper, right? And it just happened. The industry will respond when they finally, when people price things in properly, and you look at the costs, as Darisha just said, if you look at the cost of what happens to your real estate if you don't fix it, versus you look at your benefit of what you're going to get from your coal assets you're going to have to write off in the next 20 years anyway, and you time value that back today, and you say, what am I going to do today? That creates enormous opportunities for people, as long as you're being transparent and you're getting the right data in there. And it is going to be iterative. You know, it is going to continually be iterative each year, I think, in this space.
Okay. The problem sometimes is having that long-term view.
Yeah, I just want to echo what both of you have been saying, right? Because I mean, coming back to the topic of the day, which is about capital market, right, and its relation with net zero, I do believe capital market is actually very smart, right? So you know, it's able to absorb risks and adjustments in pricing levels much better than we often think about it, right? Look at the stock market performance after COVID, right? You may argue that never happened, right? That disruption didn't really impact the capital market as much. And then all the stimulus plans, right, may have even a positive effect, right, on the stock market overall. So that capital market has that incredible, you know, ability to really factor in, right, all the you know, risks and uncertainties going forward, because, right, the investors are very mature, getting mature, more sophisticated. Secondly, the disclosure, right, standards is getting up to speed, right? All the credit rating agencies, they're adding ESG, right, into their credit rating scores and all that stuff. And then lastly, also there's a proliferation of social media, right? If some company has done some, you know, negative things, right, about the environment, right, you know, the social media will get it out in an instant, right? So that's why I think the capital market over the last decade or so has been even more efficient in the way that they absorb uncertainties. And I totally agree, because credit risk, the climate risk is actually a long-term risk, right? We know it's going to happen. We know the type of impact it's going to have on all kinds of assets, right? So it's just, I think it's just needed more awareness, right, from the industry and the proper disclosure. And then, you know, the market can adjust it, right? And think about asset values in different ways very quickly. So I'm actually quite optimistic that from a capital market perspective, you know, the response will be relatively fast and relatively more efficient.
Sorry, yeah, I would also just like to weigh in on here. I don't want to be like the harbinger of bad news and saying that financial markets will, you know, not solve its problem by itself. Obviously, in the Fair Finance Asia and the Fair Finance Network overall, we believe that definitely the financial sector has an important role to play as a change agent in this whole you know, climate crisis that we are facing. But at the same time, I think we have to be very realistic in our expectations of all these voluntary initiatives, of all these potentially actions that we are thinking about, that the market will regulate itself at some point. But whether that point in time is the point that we need so that we avoid the catastrophic, the catastrophic impacts that we are looking into in the forward-looking scenarios that we already know, if we hit the 2 degrees rise in temperature, well, that's the problem there that I really anticipate. And therefore, I think in this point, yes, financial markets, yes, the financial institutions, financial sector can do their bit in terms of ensuring that these targets are there for them, that they are having these voluntary initiatives. But there is a very important role for regulators to play, to set the benchmark, the foundation, so that all these are not becoming voluntary, and that at some point, all these disclosures that we need so that we can set the proper strategies are becoming mandatory, and that all the financial institutions are being able to coordinate between each other on what type of targets they should be setting, so that when we can collectively come to an agreement of where we need to be at in the 10-year, 20-year, 30-year mark, so that we are achieving the targets that we have, and that the ones that we set for ourselves voluntarily are effective as well, not only at the business perspective, but also in the way that we think about the climate crisis as a global crisis. So I think we have to temper our expectations there. While there's a lot of positive things that are being piloted or initiated by the financial institutions, we also have to think about, the mandatory regulations that need to make sure that these are actually continuing processes with proper progress tracking, with proper accountabilities, that at the end of the day, we know who owns these targets and who are responsible for reporting and tracking their progress.
Thank you,
I just want to
Bernadette.
add a point here
Yes,
on the issue with climate change, as we've all mentioned multiple times, is that the risks are very long term. And so they're tail risks. And sometimes financial institutions, because of the way that we do valuations with TVs, we don't take that into consideration. And looking at the physical risk of climate change, chronic versus acute, we're doing a lot more on acute risk than we are on chronic. So as Bernadette said, and completely agree with you there, the regulations are very, very important. So for us, central banks are key to a lot of this, which is why the fact that there are almost 90 members of NGFS now is extremely positive, because it's grown from 8 just a few years ago. And they are starting to do a lot of these stress tests. ECB already did some stress tests. And what are they looking to stress test, I think, is also really important. And what levels are they looking at? Because that will lead to the financial institutions doing that, and then the corporates as well. But so I think that the central banks and what they do is very, very important. And it has to be mandatory. It cannot just be a voluntary thing. But obviously, it'll take a little bit of time to get there.
And I would just add that from the Asian perspective, what we've actually seen in Asia is the involvement, the heavy involvement in some cases of national regulators, national authorities, driving sustainable finance and driving the development of the industry, of course, with the cooperation and the encouragement of the industry itself. But I think it's been a cooperative kind of back and forth process that's worked fairly well in Asia so far. Perhaps not fast enough, but that's for another time. Well, I'm very sorry, we've run over time a little bit. So thank you all for those of you who have stuck with us. We had some excellent questions from the audience that we weren't able to address, but we do appreciate the questions, and please feel free to reach out to ICMA or any of the panelists individually. There will be a recording available of this if you'd like to listen to it again. And again, really from my heart, thanks to the panelists for their opinions and their insights, as well as to the keynotes. And thank you all for joining us today. We hope you learned a little bit from this discussion. I'd now like to hand it back to my colleague, Leanne, to close the event.
Thank you everyone for attending today. We welcome your feedback, so please do fill out the form which will appear shortly as you exit the event. And thank you to all of our speakers. Have a good day.